Hope that you are all doing well and keeping safe. Now, in this video, it's going to be fairly quick, but we're going to talk about liquidity and mitigation, and let's talk about imbalance as well. So understanding what they are. Now, the reason why I want to talk about liquidity is because for some reason, let me go to a different chart actually, one I haven't used today. Am I using this? No, I'm not using it. That's fine. So for some reason, the assumption is that liquidity is only sitting above equal lows and equal highs, right? But the thing is, the truth is that liquidity is sitting above every single, for example, in an uptrend, liquidity is sitting below every single low, and on a downtrend, liquidity is sitting above every single high. Why? Because you get breakout traders. Now breakout traders are setting sell stops below every low and above every high. So the reason why I say is when price comes and grabs liquidity, sometimes it's not an indication of changing trend. Why? Because we don't know. It could be just a liquidity grab and price can continue to crash. Alternatively, you can get a pullback and continue. That is your confirmation that price is changing in trend, right? Is not just this break of structure. This break of structure can simply be a liquidity grab. So don't get confused when you get in this, when you get here, right? If you get a first break of structure like this, don't assume that price is going to change and don't set your order here, because you've got no backup to say that price is going to change in trend. It could just be grabbing liquidity, right, and then continue to go. So this is where some of you may be making mistakes. Alternatively, wait for the next one just to confirm that price is going to continue, and then you can come, because we don't know if price is going to reverse after this break or structure. So don't set your order here, because price can continue up, right? If you're going to change in trend, so wait for the next break or structure, and then you have a confirmation that there's a shift in market structure. As long as momentum is in your favor, then you're pretty much okay. So that's the way to see it. So liquidity is sitting above equal highs, equal lows. Yes, that's not wrong, but it's also sitting below and above these highs. Now, another way that you can also see it is price tends to build a cause before doing what it wants to do. So for example, you'll have periods of consolidation like this, and then you'll have a shoot, and then it'll come. But what this is doing is this period of accumulation is building a cause, right? And this is where you could sometimes see your wick-off schematics, right? And then you get a break of structure with this. For example, with this case, this could be a UT or UTAD, right? We don't know, because we don't know until the schematic is actually finished. But of course, I don't use Wyckoff myself, so because I don't have to, but it's just give you a bit of background. For example, price is building a cause, right? It's trying to like induce traders in. It's trying to induce those orders before grabbing liquidity. Generally, when you get this consolidation period, this is where traders are trading support and resistance, right? So this is support, resistance, standard, right? Now, when this is broken, it's grabbing liquidity from all up here, then price will continue. So having an order block sitting here and taking a trade off that is your best bet, because it's already grabbed liquidity, but it just needs to mitigate that order, because the banks have pushed, not the banks actually, the institutions, I'll say, institutions have pushed that price up before bringing it down to break structure. But although I could say that this isn't confirmation of trend, you've got a bit more probability behind it, given the fact that it's grabbed liquidity and gone. Okay, so in that sense, yes, you can take a trade of this. But generally, if you're going off the first break of structure, sorry, let me draw that better. If you're going off the first break of structure, right, as just a liquidity grab, you don't have the best amount of probability, purely because we don't know if price is going to reverse from there unless you do another confirmation within that. Generally, when you get a situation when you have these little accumulations, then it's fine, okay, because of that cause that's building. And exactly the same thing if you were to go the other way. For example, if you were to go the other way, where you get a consolidation period, then you get a drop, and then it goes, right? That is essentially a spring in a schematic. okay? And generally when you trade off that, you have more probability to take the trade off it, purely because it's grabbed liquidity. It was built that cause, it's grabbed the liquidity that it needed, and then price is gone. Then taking the trade off here is perfectly valid. Now generally when you get impulses like this is when you get imbalance. Now imbalance essentially is understanding that every time, like within a market, right, when price is moving, there has to be 100% of each, well not 100% of each, sorry, there needs to be 50% buying and 50% selling. So for example, when you get situations where okay, let's talk about this scenario here, right there. Okay, so for example, price has impulsed and broke this structure, which we can clearly see. But where does price come to? It comes to the point where there's an imbalance in pricing, because there's more sellers than buyers. Well, there's sellers here, but there's no buyers. Okay, now that is inefficiency. Now generally I don't use the inefficiency itself. I like to have an inefficiency and an imbalance combination. So ideally in this situation I would have had an order sitting at this OB here, right? But obviously it didn't get there. But in this, what I would do is obviously I'll set my order there and I'll miss this trade. Some people like to use the 50% of the inefficiency. For me, I don't like that. But this is telling you that when you have these impulses, the institutions were active, which is why that is leaving these gaps, and it gives more of a reason for price to come back. And also what we can see here forming is we have relative equal lows. Now generally these can be used as targets, because price needs to come and break through them, because that's one touch, two touch, and you can have another one and price can continue up. Okay, that's the standard of retail traders, for example. But these can be used as targets, because price is building a cause first, which is this is the cause, then it goes and grabs that liquidity, then it continues. Okay, so that's just an example of how price actually reacts, and that is an example of imbalance. Imbalance generally, I only look at it when you're looking for an OB, for example. Let me see if I can find a good example here. Like for example, we got a breaker structure, which we can see here. Breaker structure, impulse. You got imbalance sitting between here and that wick there. Price needs to come back on and obviously mitigate this OB that created that move, and then it continued. Okay, that wasn't a great example because it wasn't a whole move, but just showing you that having that confluence that's the main reason why I say look for a clear OB. You don't want one that's sort of sitting in the middle of all this rubbish. Basically, you want a nice clear reason for price to come to where it needs to come to. So once you understand that, it should give you a better understanding as to how to understand how price is moving. Now another question that I got was understanding OBs and how to refine them. So when you get an OB like this, and say for example you get like a whole list of candles coming here. That's a bad example. Wait, there we go. Say for example this is your OB, right? So that's the last, for example in this bearish move, this candle is the last bullish candle before the bearish move. But after that, say for example you get these other candles sitting here, that is within the range of the OB. You can take the trade from the most refined one. Okay, that's one way to do it. So for example this one, I would use this one rather than the blue one, because that's the one before the imbalance and that's the one before the impulse. Now alternatively, what you can do is, if you wanted, what you can do is simply refine this OB, which is highlighting it. So let's highlight this OB, so which is there. We can just go to a different time frame, so just go to the 5 minute for example, and we can find and go down to the most refined one before the impulse. So this is the one that caused the breaker structure here. So I would highlight this OB that's sitting here. Okay, remember to include that wick. Alternatively, you can even refine it to that situation. Okay, and obviously in this situation it doesn't exactly plan out. Price in fact reacts to this OB, but in a normal situation is you'll be refining it like this. You can even go lower within that. So you want to find what's been mitigated. So although that didn't break any structure, this move broke this structure, but the OBs have all been mitigated. So price had no reason to even come here, whereas price came and broke structure and left an imbalance. So price had good reason to come back here, and that's the most refined point. So that's how you would refine an OB. So what I suggest doing is practicing just finding an OB and refining it to as much as you can, and just see how price reacts. That's the only way you'll actually understand and how to learn it. So in this video we covered liquidity, imbalance, and how to refine the OB. And I hope you found this video useful. Obviously feel free to subscribe, like the video, and also join our free Telegram where you'll find our free PDFs. We also send in occasionally send in some POIs. So for example, we took a trade today on GBP JPY, so this is what I sent in, and the trade is currently running. Let me have a look. The trade is currently running, so I took a 2-pip stop on this one. The trade is currently running at almost 1 to 25, almost. I'm not going to do the math for that, it's a bit too difficult, but this is actually a good example to show you in terms of changing in trend. Now when you get a range, now obviously we have the range sitting here. If you go to, once you find the bottom of your range and identify the OB, for example, as we have here, it doesn't matter what time frame you're going on. For example, let's go to the 5 minute. What can we see is we got a break of structure, change in trend. Now obviously we start to have this, so you need to understand is we obviously got this first move which broke this structure to the left, and then we had a failed structure, then it broke structure again. Okay, so we had more confirmation taking a trade off here rather than here. Okay, so if you remember in this situation where you got where you get a move which breaks the lows, so it's breaking lows, right? So it's breaking the lows. We don't know if this is just a liquidity grab and going to continue. Okay, we just have to wait to see what happens, and you're better off waiting for that move. So you're better off waiting for it to create a failed structure, then continue, and then you can enter off that in terms of understanding the change in trend. But yeah, so this POI was sent in, so obviously yeah, feel free to join our Telegram so you don't miss out on these POIs. To be fair, POIs are pretty easy. I've taken partials on this trade, by the way, so yeah, I think I'm running at 1 to 10. I think I took partials around here, but yeah, so essentially POIs are just finding the refined order block at the extreme. That's all it is, because we're only trading structure, nothing more than that. But yeah, I hope these videos have helped, and obviously keep the messages coming. I mean, it's really nice to see some of your progress, especially the fact that you're using it off the free strategy. Yeah, and apart from that, trade safe.